Welcome back to Talk Tickers. This is the show where professional investors come to cut through the noise and find the real signal. We dig into the earnings prints, the calls, the footnotes, all of it.
We distill it down into what you actually need to know. Because let's face it, the headline number is almost never the whole story these days.
That is the absolute theme of what we're tackling today. We are looking at a classic, good on paper, bad in practice situation.
A textbook case.
The company's an FB Financial Corporation, ticker FBK. They just reported their Q4 2025 numbers.
And if you were just a trading algorithm scanning the press release, you probably loved it. They beat on revenue, they beat on earnings per share, a double beat.
But the actual human traders,
Oh, they hated it.
they really, really hated it. Let's just set the scene. January 22nd, the report comes out. The stock drifts down maybe, 1.2%? Not great, but not a disaster.
All right, little weakness. But then the next day, January 23rd,
The floor just falls out. It drops 6.34% on really heavy volume.
that's a capitulation move. I mean, for a regional bank to get hit like that after a beat, it tells you there's a huge disconnect between what management is saying and what the market believes.
And that's our mission today. Why did a bank with an almost 4% net interest margin, which is frankly incredible right now, get taken to the woodshed? Is this a huge buying opportunity, or is it a warning flare for the whole sector?
To figure that out, you have to look past the headline beat and look at the quality of the earnings, because once you start peeling back the layers on this one, things get really noisy.
Okay, so let's start with the basics, the snapshot, just to ground everyone. What did the algorithms see that looked so good?
All right, so adjusted EPS came in at $1.16. The street was looking for $1.12.
So a solid 4-cent beat.
A clean win, then revenue, $178.6 million, which was comfortably ahead of the roughly $176 million estimate.
Okay, so they brought in more money and kept more of it as profit than anyone expected. Seems simple enough.
Exactly. And the core metrics are strong. Their adjusted return on average assets, or ROAA, was 1.51%. In banking, anything over 1.2% is considered really good. 1.5% is elite territory.
And then there's the big one, the net interest margin, or IN, the spread between what they earn on loans and pay on deposits.
It's the raw horsepower of the bank, and they posted a NIM of 3.98%.
Wow, almost 4%.
It's huge. I mean, in this environment where deposit costs are crushing everybody, staying near 4% is a massive advantage. Most banks are just fighting to keep a 3 handle on their margin.
So high margins beats on the top and bottom line.
Yeah.
And then you see the growth headlines. Loans up 29% year over year, deposits up 25%. I mean, if you showed me that data without the stock chart, I'd assume the stock ripped higher.
You'd assume it was up 10%, but this is where the whole story starts to unravel. That 29% growth number, it's basically an illusion.
An illusion.
It's bought growth. That year-over-year number includes their big acquisition of Southern States Bank. So, yeah, the bank is bigger, but it's not because they went out and hustled for 29% more business. It's because they bought another company's balance sheet.
Ah, got it. So the YOA metric is hiding the real story. So if we look at the organic growth, what actually happened in Q4?
It hit a wall, and this is probably the single biggest reason for that 6% drop. Organic loans, the ones they generated themselves, grew by only $86 million in the quarter.
Okay, $86 million still sounds like a big number, but for a bank their size, what does that work out to?
It's a drop in the bucket. If you annualize it, you're talking about maybe 3% growth. And that's a huge miss because they've been telling everyone to expect mid to high single digit.
Call it 7 to 9%.
Right. So to come in at a 3% run rate, it suggests the core engine is sputtering.
And did management have an explanation for this?
Oh, they had an explanation. The CFO, Michael Meddy, he talked about elevated paydowns from commercial borrowers. It happens. But then the CEO, Chris Holmes, said something that I think really rubbed Wall Street the wrong way.
I know exactly what you're talking about. The Christmas Eve defense.
That's the one. He literally said, and I'm quoting, "If I hadn't let everyone go home on December 24th, the point-to-point numbers would have looked different."
Look, I get it from a human perspective. We're a good place to work. Fine. But as an investor...
As an investor, it sounds like the dog ate my homework.
It sounds like an excuse. It sounds like your pipeline is so thin that a single holiday determines whether you hit your numbers or not. Investors hate timing excuses.
They hate them. It makes them question if the underlying demand is actually there. And yeah, they tried to smooth it over, saying if you look at average balances instead of the quarter end number, growth was closer to 6%.
But the market's not buying it.
No, the market is in a show me mood. They're skeptical that the bank can hit its 2026 growth targets without just going out and buying another bank.
Which brings us to the second big problem. It wasn't just the growth that was messy. The expenses were all over the place, too.
Yeah, this is the noise we were talking about. It was not a clean quarter. To get to that nice adjusted EPS number of $1.16, you had to back out a whole lot of stuff.
What kind of stuff?
It was about $5 to $6 million in, non-recurring expenses. You had higher franchise taxes for about $1.2 million that nobody saw coming. You had costs tied to a share repurchase. And then, funnily enough, you had $3 million in performance-based incentives.
Wait, hold on. They had a bad expense because they were performing too well.
That's right. The bank hit some return on assets targets earlier in the year, which meant they had to book more bonus money for the team in Q4. It's a good problem to have, I guess, but it's still a surprise that hits the bottom line.
And what about that share buyback? They bought 1.7 million shares from a state, right?
Yeah, which is a really interesting move. This wasn't just them nibbling at shares in the open market. They took out a huge block, about 3% of the company all at once.
That feels like a bullish signal, though. Management betting on themselves.
Long term, absolutely. It's a huge vote of confidence. It shrinks the share count, boosts EPS for everyone else. But in the short term, pulling off a deal like that costs money, legal fees, transaction costs. It just adds to the mess.
So you're a fund manager. You see growth stalling. You hear the CEO blaming Christmas-ese. And now you have to manually adjust for $6 million in one-offs just to figure out what they really earn.
It's exhausting. It makes the bank hard to model. The CFO is guiding to an efficiency ratio in the low 50s for next year, which is good.
Lower is better for efficiency, yeah.
But the market is just tired of doing the math. They want to see a clean quarter where the real number is the reported number. The noise fatigue is real.
That's a good way to put it. Integration fatigue, noise fatigue.
But this is where the story pivots. They have a new strategy for 2026 to fix that growth problem, and it's probably the most interesting part of the whole call.
You're talking about the talent war.
Exactly. And that incredible analogy the CFO used, the transfer portal.
I love this. For anyone who doesn't follow college football, the transfer portal has completely changed the game. It lets players switch teams basically whenever they want. It's total free agency chaos.
It is chaos. And the CFO, Michael Meddy, he directly compared the banking job market to that portal. He said, we're not just hiring new graduates, we're going out and poaching star players from our competitors.
And he gave that insane statistic about Huntsville, Alabama.
Yeah, Huntsville is a boom town right now. Defense, tech, aerospace, but the banking scene is just wild. He said 50 to 60 revenue-producing bankers have changed jobs in that one city in the last 6 months.
50 to 60. In one town, that's not turnover, that's a full-blown migration.
It's an exodus.
Yeah.
And FBK is signaling very clearly that they want to be the bank that scoops all those people up.
The CEO was so blunt about it. He said, we will not miss the opportunity because of comp.
Translation, we're opening the checkbook.
That's a bold, bold strategy.
It is, and it's a double-edged sword. On one hand, it's the fastest way to get growth. You hire a top banker, they bring their $50 million loan book with them. Instant results.
It's buying human capital instead of a whole bank.
Exactly. But on the other hand, A players are expensive. If you're paying top dollar for salaries and then you have to offer high deposit rates to bring their customers over,
your margins get crushed.
That beautiful 3.98% IM we talked about, that's suddenly at risk. They're guiding for it to stay pretty stable around 3.8%, but the costs of this hiring spree could eat into that really fast.
So you're betting that the new volume you bring in will offset the higher cost to acquire it. It's a high-stakes bet.
A very high-stakes bet. And remember, they're talking about doing this while also still looking for another traditional acquisition.
Right. They just finished the Southern States deal, and they're already looking for the next one.
And they're pretty specific. They're looking in the Southeast, the Carolinas, Virginia, Georgia, Alabama. Looking for healthy banks, they said no fixer-uppers, between $2 and $7 billion in assets.
What does that signal to you? That they're still hungry for M&A?
It signals that they don't believe their organic plan is enough. And for shareholders who just went through one integration, the thought of another one coming so soon, that creates anxiety. It could be another reason people were selling.
Can we just have a clean quarter, please?
Precisely. Let's just digest what we bought. It's complexity risk. And all this is happening in a very tricky rate environment, which we have to talk about. The deposit beta.
Right. Break that down for us. Why does that number matter?
Deposit beta just measures how much of a Fed rate change a bank has to pass on to its depositors. FBK's is around 60%.
So if the Fed hikes by 1%, their deposit costs go up by 0.6%.
Exactly. And 60% is pretty high. It means their funding isn't cheap. And if you're trying to poach customers by hiring their bankers, those new customers aren't coming over for a low interest rate. They're going to demand top dollar. So your expensive new growth gets even more expensive.
It's a real pressure cooker on the margin. Okay, so let's zoom out. The so what for an investor. Piper Sandler downgraded the stock right after the print. What was their rationale?
It really boiled down to valuation. The stock had already run up 36% in the last year.
Which is a monster move for a regional bank.
A huge move. So Piper's take was basically the easy money's been made, the stock was priced for perfection, and this quarter was obviously not perfect.
Plus the whole narrative changed, didn't it?
It completely shifted. For a year, the story was about size and scale from the acquisition. Now the market is laser focused on the quality and sustainability of their earnings going forward.
So the bear case is it's expensive, organic growth is unproven, and their strategy to fix it could kill their margins.
That's a bear case in a nutshell.
All right, give me the other side. What's the bull case? Why buy this 6% dip?
The bull case is that this is a high-quality bank in the best economic region in the country, the Southeast Tennessee, Alabama. That's where the growth is. Demographics are destiny.
People and businesses are flooding in.
Exactly. And if all this noise really does clear up in Q1, if this transfer portal strategy actually works and they post, say, 8% organic loan growth,
Then the stock is cheap.
then the 6% sell-off was a huge overreaction. You're buying a best-in-class margin bank at a discount right before its growth engine reignites.
It's a classic prove-it story then.
100%. Q1 of 2026 is the prove-it quarter. There's no acquisition to hide behind anymore. It's all on them.
All right, that brings us to my favorite part of the deep dive. This is where we spin all this data into a crazy but plausible trade idea. First, the usual disclaimer.
This is absolutely not financial advice. We are not advisors. We're just having a conversation. Please do your own homework. Don't trade based on anything you hear on a recording.
Okay, with that out of the way, I'm calling this trade the Huntsville Headhunter Long Short.
I like it. Sounds aggressive. Lay it out for me.
It's all based on that one comment. 60 bankers changing teams in Huntsville. That's blood in the water.
Yeah.
So the long side of the trade is simple. You buy FB Financial, FBK. Why? Because in a chaotic market, the aggressor wins. They're like the Alabama Crimson Tide of this situation. They have the money, the stock, and the CEO's permission to go pay for the five-star recruits.
So you're betting they successfully poached the best talent in their loan books.
Exactly. But here's the other side. Should short the small, local, maybe even private incumbent banks in northern Alabama.
The donor schools.
The donor schools. Short them. Look for the banks that have low capital, the ones who can't afford to get into a bidding war to keep their best people.
That is ruthless.
It's an arbitrage on human capital. The thesis is that in 6 months, FBK reports a surge in loans from Alabama, while these little guys report massive outflows because their best relationship managers just walked across the street.
It's ruthless, but it's completely plausible. In banking, the relationship is the asset. When the person leaves, the asset often leaves with them.
And the small bank is left holding the bag.
The only risk I see is the winner's curse.
Meaning FBK overpays.
Exactly. They get so aggressive, they destroy their own profitability to win the talent. You could be long a bank that's growing its revenue, but shrinking its earnings per share.
High risk, high reward. That's why we don't call it the safe and sensible trade.
Fair enough. It definitely highlights the dynamic.
So to wrap it all up, FBK. A headline beat that the market saw right through. A Christmas Eve excuse that didn't fly. And a very bold, very expensive plan for growth in 2026.
The market has basically put them in the penalty box. That 6% drop is the price of uncertainty. They have to prove they can grow on their own now.
So next quarter, what's the one number you're watching?
Organic loan growth. It has to get from that 3% annualized rate back up to at least 7%. And I'm watching the expense line. No more excuses, no more one-offs, just clean execution.
Q1 2026. That's when we'll see if the transfer portal strategy is a genius move or just an expensive failure.
It's going to be fascinating to watch.
Thanks for joining us for this deep dive on talk tickers. Keep watching the tape, keep questioning the numbers, and we'll see you on the next print.
Keep watching the tickers.